Awesome. Well, thank you, David, and good morning, everybody. Price Headley here. Thrilled to be with you. We got obviously a great event full of lots of fellow traders, and it's all about really focusing on what works and what fits for you, right? You've got to make sure that whatever you're doing in the markets fits from a lifestyle perspective about how much time it's going to take, about what kind of energy you can apply to any given strategy. At Big Trends, now in our 26th year serving our Big Trends community, it's always been about kind of keeping it simple, right? So we're going to keep it real simple today and focus you in on just one vehicle you can trade. The QQQs, the NASDAQ 100 tracking vehicle has been a great vehicle if you want tech exposure, if you want kind of that extra kicker, if you will, compared to the usual market movements. NASDAQ will tend to be a bit more volatile than the S&P 500 or than the Dow or than the Russell 2000, right? So you've seen it in recent days where it snapped back up pretty quickly after having snapped down on the Nvidia sell-off a couple days back, right? So you've got to be able to take advantage of both directions, and that's what we want to talk about here. We call our strategy the QQQ options playbook, about how we could get in any given afternoon, kind of getting ready for the next day or two, snap in one direction or another. And we're going to walk you through actually several setups here. So as I get things rolling, just be aware, it's not just one pattern. There's several patterns that can work nicely with this QQQ options trading approach. Now, just a reminder as we get things rolling, everything we share with you in today's presentation is based on our proprietary research, and it's intended for illustrative purposes only. What we talk about here should not be considered specific advisory recommendations today. As you know, stock and options trading have large potential rewards, but they also have large potential risk. The past performance of any trading system or methodology is not necessarily indicative of its future results. Do see our terms of use on our bigtrends.com homepage for more information here. So, with the disclaimer behind us, let's talk about what we can do and how you can construct these QQQ options trades. We're going for doubles here. We're looking for fairly quick strike opportunities. One of the beauties about a vehicle like QQQ is multiple beauties, actually. The first is, of course, it's the NASDAQ 100. You're talking about 100 of the biggest NASDAQ stocks out there. Of course, it's going to be led by the Apples and Nvidias, Microsofts and Metas of the world, right? But there's the variety of other names in the mix as well. But in addition to getting kind of instant diversification and trading just one vehicle rather than having to track all those 100 different NASDAQ names, it's also about saying, you know what, the liquidity is there where it's easy to get in, easy to get out. The pricing of the options is very competitive. There's a really tight spreads getting in and out. So you don't feel like it's you against the market maker ever. And also, these options have basically daily expirations, right? You have a lot of different expiration choices, not just most stocks are just once a week, right? If at best. And so here you've got basically everyday choices. We're going to talk about our preferred strategy, how much time we like to give ourselves, and also then walk you through a bunch of chart examples, success stories when it works. Also talk about when it doesn't work. Look, every strategy you do is going to have times where it wins, times where it doesn't, and your job has to be to manage through that uncertainty and know that it's about always being consistent in your capital allocation, right? One of the things in my 35 years of options trading has been like to make sure that you never go all in. Okay. I know that's so tempting for so many traders to want to plunge in, plunge out, just rush it all in, just hope that you hit it rich, right? And that's not a strategy. The strategy is to be consistent in your capital allocation, to be disciplined and saying, look, you want to be in this game for the long haul. You don't want to let one trade make, or worse yet, break you, because that's not going to keep you in the game long haul. Even if you get lucky on a short-term basis, luck is not what we're after here. We're about taking an investment edge and then creating a strategy around that edge, right? So that's what we're walking through today. We call it QQQ Options Playbook. We give you the kind of insider's playbook look at exactly what the system is. Once you get signed up, I'll give you an overview today, but once you get signed up, you actually get all of our rules and settings for every different pattern that we might want to trade, and also for the times we don't want to trade, right? So it's all about knowing when you should be pulling the trigger and when you should be waiting, right? So I think something that's hard for a lot of traders to understand is you come from an environment in schooling and in our work careers where you got to show up every day, right, to get paid. You can't mail it in. You can't say I'm going to take a bunch of time off and not unless it's vacation time, expect that you're going to keep your job, right? You got to keep showing up. Same thing with school. We're used to doing our homework and then expecting that we're going to get the grade from doing the hard work, right? The problem with the markets and converting that is you can dig yourself a bigger hole if you get into a position that's not working. You think, well, I'm just going to keep on averaging into a bad trade. I'm going to keep on adding more good capital after bad. Determination will get me there. Not so fast, right? You've got to be careful. And a big part of understanding how to succeed in the markets long term is how do you align yourself with the right principles, align yourself with that the markets are giving you feedback that you're on the right track, right? If you're on the wrong track, maybe better to get off that train, take a little breather, kind of I forget which philosophy it is that says, hey, the longer it takes you to recognize you're on the wrong track, the longer it's going to take you to get back to where you should be, right? So that's another good reminder that, then if you're on the wrong track, time to get off that train and kind of reassess and look at how to get on the right train, the right trends, right? That's what we're about. So we're going to walk you through the strategy. It's one of our newest in our big trends arsenal. If you don't know me, I've been trading stocks and options for over 35 years. I caught the trading bug while I was a student at Duke University back in the late 1980s, post 87 crash, and really kind of got my eyes open to the power of active trading and pretty much decided then that that's what I wanted to do with my career. So I launched BigTrends.com in 1999, just over 25 years ago. And it was always about a systematic approach, right? Everything we do has got to be grounded in data, grounded in a quantitative advantage, nothing that's like just a gut level decision, right? If you're trading from your gut, what you're going to find is that there'll be times you're right and you feel really good, and times when you're wrong, you feel really bad, right? You got to separate those feelings and start to say, let's get out of the feeling mode and get into the actual analysis, data, evaluation mode. And if anything, kind of almost better to be executing something else that you don't have that emotional investment in with your ego, right? Because your ego is another thing that can hold you back in your trading. Because what does your ego want? Your ego wants to be proven right. And so when you're not right, you say, well, I can't close this position until I'm proven right. That's a big mistake. That's how small losses turn into bigger losses. We don't want that to happen. So let's get that ego out of your trading as well and keep that systematic focus. So a lot of people come to big trends because they're saying, hey, let me execute a system that's worked for us and that can work for you as well over time, knowing that, hey, any one trade can win or lose. It's about following a systems, a playbook. And that's what we call our QQQ options playbook for that reason. It's like, okay, we'll call out real-time email alerts, and our system will be based around a simple but effective set of different scenarios that can essentially develop based on price action and based on kind of an underlying indicator setup. The indicator on the bottom panel here, we're going to talk more about it, is the Williams percent R, the Larry Williams percent range indicator. We flip it on the scaling to kind of use more of a what I would call a grade school scale from 0 to plus 100. And we've got a couple of several actually different patterns that can give us trades. What we don't really like is to take trades kind of in the middle of the range, right? The middle of the range should be somewhere you see between about the 40 and 60 percentile. You can see this one was above the 60 percentile when we got our signal on this one coming up here as it started to rally back up here a couple days before Christmas. And you can see here that stocks trading here, this is the Qs, I should say. The Qs is technically an ETF, an exchange traded fund, but it's a mix of the 100 different big NASDAQ stocks. We're trading in the neighborhood of about 523 or so. We were buying a 522 strike call, and we're buying it with about 3 days to go till expiration. Now, we're not going to hold it for all 3 of those days. We're going to hold it for up to and no more than 2 future days and always get out before that last day of the expiration. So in this case, of course, you got a Christmas Day holiday in there as well. Markets didn't trade on the 25th, of course. So we're getting in on the 23rd and planning to look at the 24th, the 26th, and then the 27th as the 3 trading days. But of course, before the expiration, the 27th is not a day we would hold the position. So we know we'll be out at the latest by the 26th. Now, in this case, the next day on Christmas Eve, the Qs snapped up, right? We bought the calls per our pattern that said it was showing us good upside momentum. And you can see that it followed through the next day from 523, went as high as about 531, right? So 531, that option is worth about $9, right? You've got a right to buy at 522. If you're new to options, you buy a call, it means you own a right to buy the Qs at that fixed strike price of 522, good until the expiration, in this case on the 27th. Certainly, our objective is not to hold it too long. And the ideal is to be able to cash it out the next trading day. But what we also don't want to do is we don't want to generate day trades. So if you're a smaller account that's trading these, even if it's a $5,000 account, you could trade these very easily and say, okay, you just adjust the amount you invest per trade. But the goal is to say, look, if you're focused on, okay, I don't want to day trade, well, we get into these trades in the last about half hour before the QQQ options would close, around 3:45 p.m. Eastern. You say, hold on, that's 15 minutes before the cash market closes at 4. But the options on the Qs, like the options on the SPY, will trade till 4:15. So you have the opportunity to get in over that next half hour or so. But the important thing is you're getting in right at the end of that daily candle here. So meaning that you know that you're not going to get your target, which for us is a target of a double. When we can get a double, we take the whole thing, book them Dano, take the whole profit. Don't try to take a partial and try to let the rest ride. You just don't have that much time left, and we don't want to get too cute and see a double slip away. So if it does go on to a triple, those can happen, but also the doubles can turn back into break evens, right? So the double is something we're happy to book when we get the chance. So in this example, look what we paid. We paid $391 per contract. Remember, each option contract controls 100 shares of the Qs, the QQQ vehicle, which would have cost you over $52,000 if you bought 100 shares, right? So you're controlling $52,000 plus of QQQ value for just $391 in this example. So you can see that the leverage here is dramatic, right? So the Qs pop about a little over 5 points, a little over 1% on the Qs, and we're able to cash these out from 391 to 782. So we're making $391 per contract. Before commissions, remember the commissions are now down to just a buck in options contract with no ticket charges. So you can just do a one lot and pay $1 in and $1 out, $2 round trip per each entry and exit on one contract, right? So the beauty of this is that, okay, we doubled it the next trading day. You don't have a day trade. You don't have to hang around and wonder what's going to happen next. You take your double when you can get it. And so we got it there, back there right before Christmas, the day before, on Christmas Eve, we booked it. So talking a little bit more about strategy guidelines, and we're going to go through a bunch of other examples, but our holding period can be up to 2 future trading days after our entry with never having a day trade. There's actually 3 different configurations of the percent R or percent range indicator that we can get a potential signal on a daily chart. We'll talk a little bit more about percent R and how it's calculated as well. Look at the next chart. But bottom line is that, we're just doing a straight call purchase or a straight put purchase. There are no spreads here. There's no options selling on the front end. It's just you buy a call and then you're going to sell that call when it's time to close it. You buy to open on a put and you sell that put. Remember, if you buy a put, it's a right to sell the Qs in this example. And of course, that gets more valuable as the Qs drop if you own a put option, right? So the put is a bearish or downside play. Of course, in all the examples we share with you, remember that past performance never guarantees future results. Any next trades, it can vary from what our last trade is. You should expect that variance. What you'd expect is it's about a systematic edge that you're trying to apply to the market. So taking a system and then saying, okay, I just have to focus on the one vehicle. I also just have to focus on when the trades get sent out. As I said, around 3:45. In this case, we showed 3:40. So in that last 15 to 20 minutes before the market closes on a cash basis, but remember that the options keep trading until 4:15 Eastern Wall Street time. So we just have a once a day action point, right? On a Monday through a Friday, any given trading day. We don't try to watch the markets all day, every day with this strategy. It's actually really nice for not just you, but for us and my research team to say, okay, we have a variety of different techniques we develop, but the bottom line is with this one, we're just doing our scanning there in that last hour or less, kind of getting ready for, do we have the right configuration potentially to get a trade? Are we close to it? And then part of the reason you don't want to put this trade on before that is that you don't want to bet that you're getting a breakout earlier in the day and then it flips on you by the end of the day, right? If you're using daily candles, daily patterns, you want to know if that pattern's in place right near the close. It also will make sure you get in before the close so then you can get out the next day at the earliest and not have a day trade. Also, it will help you to scan and help you to know you don't have to sit around and watch the markets all day every day yourself. You can enjoy your time doing a variety of other things and just check it there. Of course, I've got a team that you can always call or contact if you have any questions there at 3:40 or 3:45. You haven't seen a trade you thought you would. You can always reach out to us and make sure you didn't miss anything. But we send a real-time email, and you can also get it as a mobile phone update now through the WhatsApp technology as well once you become a subscriber. We call it 3 DTE options. What does that mean? It means 3 days till expiration, 3 trading days until expiration, right? Obviously, the markets don't trade on weekends. So if we got a signal on a Friday, we'd be looking out to the following Wednesday's expiration for the Monday, Tuesday, Wednesday, full 3 days ahead before expiration. So that's kind of how we would set our time frame, knowing that our goal is to get the profit in the next day or at most the next 2 days, right? So that we'd be out with still a full day left before the expiration at the very latest. This gives us plenty of trade opportunities and it gives us plenty of trades that can give us meaningful pops, right? So how do you get that bang for your buck while always managing your risk? Of course, going 3 days to expiration means you're going to not pay as much time as you would if you bought a month till expiration, right? So you're looking to kind of shorten that time window up. This is interesting when you go back to the beginning of 2023, just over 2 years ago. Our average entry price on a contract in this strategy has been $3, which means $300 to control each 100 shares of the Qs. So let's say on average you're putting in $1,000 a trade. That would get you on average about 3 contracts in at $300 a piece would be an average of about $900 invested on $1,000 cap, right? If you're putting in just say $500 a trade, that might only get you 1 contract in on average for $300 per. So you got to kind of keep that in mind. Of course, if you're putting in more than 1,000, you can get even closer to your max full investment as you get more dollars to work. But you always want to make sure it fits your own unique risk tolerance, right? We don't want you taking too much exposure on any one trade. Like I said, the latest we would hold a trade after we got in would be 2 trading days later at 3:40 p.m. Eastern would be our final time exit if we haven't hit a profit target or a stop loss by that point. So this will avoid us holding into the final day of volatility and the final day of also, of course, time risk, right? That time risk is something obviously every trader cares about when options traders care about when it comes to the time decay, the time burn, what's called the theta in the options pricing model. That decay of that time is like the melting ice cube of time. It melts faster as you get closer and closer to expiration. So of course, the fastest it's going to melt is in the last 24 hours right up and into the expiration, which is something we also want to try to minimize that risk while we get out with at least a day to go before those options expire. So why should you care? When you look back at our overall performance going back to the beginning of 2023, so now we've got, with this month almost ended, we've got 25 months or so in the books. You can see that if you started with a model $25,000 portfolio and you just took to start $5,000 per trade, so you're saying, okay, that'd be starting off with about 20% allocated per each trade of that model portfolio. What's beautiful about this is that amount will decline as the portfolio grows. So we kept the same fixed at $5,000 maximum even through our most recent trade the other day, saying that okay, now the portfolio is growing from 25,000 to $134,750. That's a gross value before commissions, before subscription investment. So before those two things, the gross profit is over $109,000 in 25 months, right? So you break that down per month, and you're saying, well, that would be averaging over a $4,000 gross profit per month on average, right? Some months better, some months worse. But the idea is that, okay, obviously in a growth perspective, you say that'd be a 439% gross return, 25 growing into 134 and change before that commission, before that subscription investment. So point being that it's about consistency. The reason I like the fixed dollar amount and not trying to keep growing your dollars allocated per trade as your portfolio grows is that what'll happen is if you keep growing it and keep on trying to compound the amount you invest per trade, after a good run that feels really good for a while and then you get a drawdown, you get a give back phase. It's going to happen it happens to all of us. I expect it to happen. My 35 years of options trading, I know it's going to happen, and I know that that's why I want to make sure that you don't give back your profits even more quickly by overcommitting your amount invested per trade. Be consistent in that dollar amount. I think you'll find it's a more stable way to keep you in the game for the longer haul. As you know, past performance can never guarantee future results. Future results are going to vary, right? The next 25 months could be worse than this, could be better than this. I mean, you just don't know. But what you know is it's going to vary. There's going to be ups, there's going to be downs. But the objective is if you have an edge in your system over time, you should be looking to exploit that by steadily allocating your capital, not getting too high or too low. If we just had two winners in a row, you're not loading up on the next one. If we just had two losers in a row, you're not bailing on the next one, right? You're following a consistent allocation strategy. Notice that the numbers go down a little bit as you shrink the amount invested per trade to just $1,000 a trade, because what'll happen is you won't quite get a full allocation per trade. So our gross profit went down to only 380% gained. $5,000 portfolio turned into over 24,000, thus over $19,000 of gross profit. Again, before commissions, before subscription investment. Again, past performance can't guarantee what the future results will look like. Future results will vary. But the beauty of this is that we're just using the one vehicle on the Qs. We're watching those 3 days out till expiration options. We're keeping things really simple and really effective as a result. Now, when we talk about setups, each day by our categorizations could fall into one of up to 8 potential patterns or categories. So 3 of those 8 are tradable patterns in our view. That means over half of them are not patterns that we would trade, right? So we're using some selectivity here to say what's the best types of setups. Like I said before, we're using Larry Williams' percent R or percent range indicator. And percent range is calculated, typically to look at the most recent, whatever look back time frame you want to look back, whether it's 5 days past, 10 days past, 20 days past, a year past. You could do it on any time frame. We give you what our preferred settings are when you become a subscriber. But the idea is that concept wise, you're saying where are we within that look back high to low range, right? That's what percent R will show you, right? If you're closing on the exact high of that recent look back period, that's going to be the 100% reading. If you're closing on the exact low over that same look back period, that's going to be the 0% rating. Or if we're stuck in the middle of that range, it'll be a 50% rating. So that's how the percentile within the range is calculated, right? That makes sense, right? But then what we're looking at is certain windows, certain patterns, certain setups, combining those percent R readings with how the candlestick patterns are looking. The candlestick patterns, we show you can be showing you positive closing momentum compared to where we opened. You can see negative momentum when it gets a red candle closing below where it opened. So we're looking at those things together and then coming up with potential tradable combinations. We're also looking back over oftentimes 10 years or more of data to use what we call the historical profit factor. Because a lot of people ask me, hey, sounds interesting. What's your win rate? Well, win rate is only part of the equation. The profit factor will encompass win rate, and it'll also encompass the typical size of your average winner compared to the size of your average loser. That ratio is also just as important as your win rate, right? Because you could have a 90% win rate, but when you lose 10% of the time, you lose 10 times what you make, right? And you give back all your profit, and that wouldn't be a very good system, right? So the idea is that what we look at is that combination to tell us which were the best days to get bullish or long, betting on the upside, buying a call. If it's a short trade, that means we're bearish, betting on the downside, buying a put, right? Or neither, there's not an edge. Let's not trade into the next trading day, right? You are obviously, whenever you do overnight trades, you've got that theoretical risk that, hey, there could be a gap in your favor, there could be a gap against you, right? Obviously, we're looking for that momentum combination pattern to tell us that the potential of the gap should benefit us more than it should hurt us over a large sample of trades. Let's look at some more trade samples. And we go back and look at one here on the Qs back in early December, where we're getting obviously some really nice strength. Notice the percent R reading has climbed up into the high 90% range here when we're getting our signal. Why is that? Because you can see we're closing up into or at basically the highest level. So we're right up into the top of that range. Now that, when I say that we're into the top of that range, that would make it sound like, shouldn't you sell that? Shouldn't you bet it's going to reverse? But what is kind of a misnomer here is that, and sometimes that joke and say percent R can turn into percent T, meaning the percent range can actually tell you that you're in a new percent trend phase, right? The trend phase means you keep breaking out to higher and higher highs, and the range essentially expands. And that's what happened here, right? We got our signal. It's actually breaking out to a new high versus where it had closed a month before or traded to a month before, and saying, okay, we know that this is in our view setting us up for a potential um, opportunity here to get more extension to the upside. And in fact, this one we bought the 516 calls near the money, maybe a hair in the money. We're trading maybe just a little over 516, maybe 516 and a half. We paid, so there's not a lot of intrinsic value there, but we paid $316 a contract. So that a good part of that trade, probably 80% or more of that trade, is time risk. That's a reality. But we also know that, hey, if you pay 316 bucks, your effective break even is 519.16 at the expiration. Now, we obviously want to get past that, but we also know if it moves quickly to that, we can be profitable because that's an expiration break even. Before the expiration, you can be at break even with a relatively small move in your favor. As you can see, it gapped up the next day to 520, traded to 523 and a half. So you can do the math at 523 and a half. You own a right to own the Qs at 516, right? At that high, theoretically, 523 and a half, it's worth about $7.50. Now, we're only targeting 632. We actually got filled at 634 for 100.6% gain that next morning. Whether it keeps going or not, we really don't care. The point is that it's about capturing a window, a sweet spot of opportunity, capture that window, book that double, and then move on to the next opportunity, right? So if you're investing $1,000 maximum, you get 3 contracts at 316 bucks a piece. We get you in for a total of 948 bucks, and then you're taking out about 950 bucks when you exit those 3 contracts for $318 profit a piece, right? $954 gross on minus $6 round trip on your three in, 3 out, and you're making like 948 bucks on that trade after all. So after the commission. So the bottom line is that, okay, double your money the next trading day in this example based on the strength pattern, right? So there's one pattern for us that's kind of a strength continuation, essentially a trend pattern. Another one's kind of a bounce back from an oversold type of a condition. And in fact, right before the presidential election, in fact, a couple days before it, we were getting that election uh, result was going to happen after the Tuesday close. But on the Monday close, right before the election, we got a signal that said, look, we're too oversold here. We're under this kind of 40 to 60 sort of no man's land area. We're a little bit oversold. We're showing some stabilization here, and we're buying on a 486 call. Those options were expensive back then because of the election result, right? The election result priced in the November 7th options, and that's okay because we still made our target, right? We paid $401 a contract for something that was about 5 points above the market, out of the money by about 1%. And you say, hold on, isn't that really risky? And we're saying, well, we think it's worth that risk because we were planning to lock that in even before the election result hit. Now, notice the next day it does rally from 486 to 492. And we get a situation here in which for that over 1% rally, then you're looking at that $401 turning into $805. So we got about 4 of those 6 points in the Qs and the options, right? So those options doubled. We took it out the night of the election, but we got out before that day's close. Okay, so we had no event risk coming into the election. The market gaps up on the news of the Trump victory, and our system says now we're back into the really strong pattern of the percent R actually showing you a breakout over all the prior resistance, right? So we're closing up near the top of that range, telling us that we think there's continuation potential here just under 506. We're buying the 505 calls out 3 more days till expiration on that day, and then the next day it rallied from 505 or change to 514, the next day's high, up almost 2%, 1.8% rally. Our 409 option goes to 820. We book 100.5%, 100.49%. So you could have bought two contracts for up to $1,000 that puts you in for $818. You can see that you're taking down 822 bucks overall profit, uh, minus the $4 round trip commission, made you the 818 again, right? So that's what happened in those two trades, both right before and right after the presidential election. So it shows you how we would manage a theoretical volatility based event and still not be afraid of it, because we can hop in, hop out before the event. And then after the event, we can, of course, have tradable setups as well. But not all winning trades are going to hit their double target, right? Here's one that hit the time stop 2 days later. This was a Q's bullish entry back here late October. We got in the gap up, right? So we've got some positive momentum here on that gap up. You can see that we're in the top 20% or so of the readings on the percent R. So that's relatively strong. We're about 495 on the Qs. We buy the slightly out of the money 497 calls. It rallies up over the next couple of days to about 501. And, so in theory, near that day's high, it was worth about $4 intrinsically. We still had another day to go before the expiration here. We had paid $3.50, $350 a contract to control each 100 shares of the Qs, which would cost you $49,500. So theoretically, more than 100 to 1 leverage. And then we get out there as it has about a 1% rally. We make 48% on the trade 2 trading days later, 48 hours or so later, right? So it worked. It just wasn't quite as powerful as maybe some other examples that I've shown you. But it's a good reminder that not all of them are going to get to that target. And there's also going to be risks. So we're going to talk about stops here in a little bit too. But the idea is that what the beautiful thing about this approach is that we've been averaging up to 8 new trades per month on this QQQ options playbook. Whether we buy a call, whether we buy a put, it's about saying, well, if you think about it, there's 20 or 21 trading days in a month on average, right? So you look at that and say, well, if we can generate new trades on about 8 of those 20 days, we're generating trades about 40% of the days, right? And you say, oh, I wish I could trade it every day. Not if you don't have an edge, right? You must always maintain your edge through any given market environment. Now, we talked about bull trades, but here's a bear trade example. And this is kind of interesting because you see the Qs in this example had been down, right? And you can see that we've been breaking to new lows. We'd undercut the prior old low, breaking to new lows. And see, the day before we got in, the Qs were scraping down in the single digits on their percent R reading. So we're closing to the bottom of the range. But then it snaps up here, and you say, well, isn't that snap up a big upside reversal? And our data said, you know what, this is actually bringing us back into an area where we think it's actually an area you can fade that bounce move, that first time bounce, and bet on it snapping back down. You can see that we got into the 268 puts. Maybe we're trading near the money or slightly out of the money, 268 and a half or so, it looks like on the chart. And you say, okay, well, we're slightly out of the money and we're paying $3.50, 353. That's $353 to control each 100 shares on the downside. And you can see that then it snaps on back down the next day to 260 after opening a little bit against us at 270. So the idea is that we don't want to get whipsawed on our stops. We're going to tend to put our stops in at a 50% give back, right? We're targeting a 100% gain. A 50% give back means our reward is twice what our risk is. That's our goal. So that was a bear example where we caught that. But here's a bull example. This is one of the ones that's like where it's too oversold. You can see we had popped down. Now as it bounced back up, then it kind of stabilizes back into some support here. We've got it back down under the 20th percentile in the percent R. We're betting that the snapback's going to happen, and indeed, the very next day it goes from that 435 zone, snaps back up hard to almost 450. That's a huge move in a day, right? So that was a great example where we were able to catch that quick move, really benefit from that type of unusual pattern where it's too oversold but ready to bounce. So we're kind of covering both ends, both extremes of the spectrum, rather than trying to trade in the middle where it's less clear kind of who has the edge, right? I'd like to know that either the markets are in a good trend mode where they can continue, or that we're in a snapback mode if I'm going to be buying calls coming out of an oversold condition. So we're kind of covering both ends and extremes of that spectrum. On the bear trade, as I showed you, it was kind of like we've been in a bear trend, but then we're kind of catching kind of a re-entry area after it gets too much of a bounce. And let's face it, not every trade's going to win. We've got to talk about losers too, because losers are going to happen. It's just part of the reality of trading. So here's one that we really liked where we were like, hey, it looks like it's checking all the boxes here. We've got something that's going to the top 20% of its readings here, about the 80th percentile. Looks like it's a pretty good looking trade here around 509 on the Qs. We're about a point in the money buying the 508 strike calls in late November, going out to the December 2nd expiration. Now, we paid 333 bucks per contract, right? So if you're investing $1,000, that would get you 3 contracts in for 333 bucks a piece. Now remember, we're using a 50% stop loss, and we're saying, okay, well, what's a 50% loss? What's in down there around a buck 67, buck 66, right? Well, we got out of buck 56. You say, hold on, why'd you get out worse? Well, sometimes this is called slippage. When your stop gets hit, by the time you get filled, it might be a little bit worse in a fast moving market, right? So we're out at a buck 56. We lose 53.15%, a little worse than our 50% loss. That slippage is just sort of a fact of life in the speed of movement of the markets. And say, if you get a little slippage, just realize it's part of the game. Hopefully your upside slippage over time can average out with your downside slippage and make it still feel palatable on why we're doing what we're doing. So in this case, you can see it didn't fire. We thought everything was good to go. It opened a little lower, and about halfway through that bar, as it popped down from about 509 back to about 505, we're down about 0.8%, and we're losing 53% on this call option. And we're saying you got to get rid of it. You can't afford to hold and hope with options trades. You must be disciplined. You must be consistent, and make sure that your method shows enough ability to achieve your objectives that it's indeed doable for the average subscriber and the masses as a whole, getting in and getting out based on what our real-time signals show when we send them out to you in a real-time email as well as a real-time text alert that you can get. But sometimes, in addition to a little bit of slippage against us, you can get some gap past your target levels, past your double expectation. This winner I'm going to show you here was a little bigger than expected, and it was one where you see that the Qs have been just kind of slowly and steadily kind of grinding up. And our system in this case said, look, here we are finishing the top 10% or less of the readings, right? We're showing great strength, relative strength. We're trading around 485. We're buying slightly in the money 484 calls here. And so we're about a point in the money, but we're paying 391 bucks a piece, right? So maybe a buck of that, almost $4 of that option is the intrinsic value portion, meaning almost 3 out of 4 points of that is the time risk. So maybe about 25% intrinsic value, 75% time risk. In the old days, there's no way I would have wanted to take that type of a risk. But what we've seen is that these options can be expensive for a reason, and also that we're not going to hold them for very long. So when we buy it there at 391, you can see that we are 391 bucks per contract on the 484 strike calls. We're betting on a rally, and you can see we get the big gap up the next morning, right? Right off the open, we're trading up near 494 or so, right? 493 and a half. And so you can see here that thus we're basically trading at about intrinsic value around 9.5 at 493 and a half. And so we book it at 955, so that instead of being a double, it ends up being 144% profit on those. Say if you bought $1,000 worth, that gets you 2 contracts in, your 2 contracts out. Each contract on the way out ends up making you about 500 and what is that about? I'll take that back, about 640 bucks, 636 bucks. So times two, you can see you're making like $1,270 of profit on the trade when you were only expecting maybe to make like 391 times two, right? Maybe make almost 800 bucks on the 2 contracts you would have bought. So you make well over what you expected to make. So that's a nice benefit when you get those gaps bigger than expected. You know, gaps can kind of go both ways. So the point is that you have to be willing to kind of roll with those punches and realize sometimes you're going to get a better than expected gap, sometimes a worse than expected gap. Some would say that trading these 3 days till expiration options can be seen as aggressive. My view is that, you know, probably the most popular options, it doesn't mean they're the best options to trade, are the most popular ones these days are the 0 DTE, you know, getting in the morning and getting out before the options would expire at the close. that's not enough runway for us. It's not enough opportunity. It's not enough stability for us. So I'm not advising that you go that close to an expiration. We feel like 3 days to expiration and knowing we won't hold it on the final day of the option's life is a much more sound approach. And that also means that you've got time to act. You don't have to screen watch all day. You don't have to sweat, have what I do in the next hour. You know that when we get out, we still have a whole nother day before those options would expire if we get out on that afternoon before the expiration day the next day, right? That would be the latest we would hold a trade. So it just really keeps it clean and simple and allows you to focus on exactly how you can put this to work for yourself. The key is with any effective system, do not get too high, do not get too low. Be consistent in your capital allocation. So whatever you determine is a risk capital that you feel like you can stomach, whether you make a double or more importantly, whether you hit a 50% loss, do you feel like you can stomach doing that again and again over a large sample of trades? If you came in late on my presentation, of course, I was showing you that if you went back to the beginning of 2023, so just over 2 years ago, about 25 months of look back, you'd have over $109,000 in gross profit, starting with a $25,000 model portfolio, putting in 5,000 bucks per trade and never any more than that. We never compound that number up. We keep it at a maximum of 5,000 bucks a trade on a starter $25,000 portfolio that would have grown. As you can see in this example, over $134,000 gross. That's gross before commissions and before subscription investment. But the key is that with a smaller account, you can scale accordingly. Remember on all these examples of the past performance never guarantees future results. Future results will vary, but what won't vary is our consistency and commitment to following the plan, right? There's going to be winners, there's going to be losers, and it's our job to continue to execute to make sure you're capitalizing and all fellow subscribers to QQQ Options Playbook are capitalizing on our systematic edges that we've developed over the years. So if you go back to a smaller amount to invest, like if you're starting with, say, a smaller $5,000 starter portfolio and saying, well, obviously you're not putting 5,000 in, that'd be an all in. Never do that. If you put in, say, up to 1,000 bucks a trade on that example, keeping it at the fixed maximum of 1,000, even when you've grown a $5,000 portfolio up beyond 20,000, we're still using 1,000 bucks a trade or less than 5% of the account now versus what it started at. So the idea is that 1,000 bucks a trade in this example generated $19,000 gross profit before commissions, before subscription investment over the last 24 months, 25 months, I should say, since the beginning of 23. So you can see that would have been a 380% gain gross on that model starter $5,000 portfolio value. So the beauty is it keeps it really simple, keeps it really effective. So like we said, that's just the profit. The gross portfolio value grew to $24,047. Again, gross before commission, before subscription investment, keeping it at that fixed 1,000 bucks a trade maximum, right? So that amount that you're investing per trade actually becomes less and less as a percentage as you grow your portfolio more and more. So the goal, like I said earlier, was that we don't want you scaling up off of a winning streak and then having a lot more dollars committed to future trades and then going through a drawdown and now all of a sudden you give back your profits too easily, too quickly. You work hard for these profits by, executing consistently and showing great trading discipline. And so you should make sure that you're not letting it slip away easily. You're letting it kind of basically go through the ebbs and flows of the market. The ebbs and flows of any system that I've ever worked with in my 35 years is going to have ups and downs. I've never seen the perfect system, and I would be wary if I did, right? The reality is that you should plan for how you're going to manage not just winners, but how you're going to manage losers, how you're going to manage cleaning up trades. Also, how you don't do dumb things like never average in, especially on an options trade, never average down on a losing trade. That's basically throwing good money after bad historically. And so you say, well, how do you get started? How can you take advantage of these? We've set something up, a great special here, and we want you taking advantage of it with real-time trade alerts that you can get as soon as the strategy triggers a fresh signal. Obviously, the next signal we possibly could get would be later today around 3:40 p.m. Wall Street time. So here in another roughly 4 hours. That doesn't mean we're going to have a trade, but it means that that's when we could get a trade, right? We will never force a trade. But you say, okay, so how do you get access to this? We call it QQQ Options Playbook. And it's partly called Playbook because not only do we have really clear entry and exit instructions on our system, but you're going to also learn the system, not just me give you black box trades. You're going to actually be able to look under the hood. You're going to actually get to see how this thing works and get a lot of education, a lot of what we call learn while you earn training. So normally, if you're going to buy, say, the next 3 months, which I feel like 3 months is a good evaluation time frame. It's why I'm setting it up this way. I don't think a month even is really fair because then you can have like a quick little win or loss streak, and then somebody's judged it based on just a very short term judgment. So I want you kind of looking out over the next 90 days saying, hey, in addition to getting 90 days worth of trade alert potentials, right? Like I said, we can have up to 8 trades a month. So over the course of 90 days, we would expect you would get a couple dozen potential trades to really get a more true evaluation of how the QQQ options playbook system works. But it's not a black box. We will give you access to the settings and rule sheet. We will give you also weekly video training from me. So I give you basically a little coaching session every week about what I saw, what we did this past week in QQQ Options Playbook for better or worse or both. Kind of like how the winners worked, how the losers worked, how this portfolio is doing, and also kind of how it's setting up to be structured as we look ahead into the next week as well. In addition, you get continuing access to me and my analyst team via a dedicated email address that we give you to our Big Trends research department. So that way, if you've got a question for me and my analysts about a trade that we called out, you didn't understand it, you were trying to kind of understand more about it, we can certainly help you there as well. But just on stuff that we've called out for the benefit of all subscribers. Now, remember, if you bought off my website, you pay 297 bucks a month times 3 months would cost you 891 bucks for the next 90 days worth of access. But I've done something dramatic here. Thanks to David and his team, wanted to give you some extra savings and just basically give you something where you can really get a sweetheart deal and really try it out for a longer period, like the 90-day access here. So to get the next 90 days, the next 3 months of trade alerts for QQ Options Playbook, plus those bonus educational resources, including the ongoing support that we give you, not just a one-off little handout, but actually ongoing live body support from me and my research team, you're marking that 891 bucks down to only $177. Why do I do that? It's less than $2 a day if you break it down over the next 90 days. Less than $2 a day, 177 bucks total gives you the access to the rule sheet, to the education through the weekly coaching videos, and of course the support from me and my research team. I do it because I see so many happy people that spread the word about Big Trends. It's why we've been in business now in our 26th year and counting. And this link is the link you're going to need to go to. It's kind of a unique link here, so I want to make sure that you have it here. And basically, uh, David may post it. So David has posted. Thank you, David. I appreciate that. So, bottom line is that it's not a www link. It's members.bigtrends.com/QQQ. And with that link, basically, it's something where we want you thinking like a member. So that's our member site access actually. So when you become a member and get signed up at this phenomenal $177 value for the next 90 days, and there's no auto billing in the future, try it for the 90 days. We think you'll like it to want to continue, but if you don't, it'll just expire after 90 days. But I think you're going to want to stick with it. But point being that once you're thinking like a member, once you're thinking longer term, don't want you loading up on the very next trade that we send out. Once you're saying, look at it, you've got plenty of time, so let it kind of fall as a process over a larger sample of trades, and let the system ultimately prove it to you. Don't just take my word for it. Let the system prove it to you and show you not just what winners look like, but how we handle losers and how that stacks up over time as the edge kind of gets extracted over a larger sample of trades. I'll show you that order page in a sec, but let me just kind of remind you some of the questions that we do tend to get so you can understand a little bit more about what we're doing here. Well, a big part of what we're doing is we're simplifying it. We're keeping it really simple. The KISS principle has, in my 35 years of options trading, I'd say anytime I try to complicate something and make it like too too restrictive, too many different layers, too fancy of a strategy, usually I'm leaving some money on the table, right? I'm either missing trades that I could be taking that could still be profitable, or I'm requiring too many things to happen where basically maybe it even makes you get in too late to a trade that otherwise might have been a good setup if you didn't put too many restricted filters on it. So usually less is more in most of the testing and strategy development work that we do here inside of big trends, right? So keeping it simple serves you. So we're just buying a call or just buying a put. We're not going to be doing spreads. I'm not going to be doing options repair strategies. I'm not going to be trying to leg in or leg out to certain legs of a trade. No, it's all just keeping it really simple. And even in this case, we're not even taking part profits and trying to trail the rest with a stop or anything. It's just basically get the double, book it, hit the stop loss, book it, hit the time stop, close it out, shut it down. So we basically cover every potential outcome that you could have, win, lose, or draw, and guide you through. Never leave you hanging on every trade. We'll always clean it up, remind you what needs to be done to clean up each and every trade. How we get the trade alerts? We'll get your real-time emails. And remember what time I said we'll get them to you? At 3:40 p.m. on the way into the trade, right? And then we'll send you a follow-up instruction saying, okay, we've been filled at this price. Here's where we're putting our targets to sell half of the double, or if it hits a stop, or if we are not half at a double, sell the whole thing at a double, or if it hits our stop, sell at half of what we put into it, right? So the make 100% versus lose 50%, 2-to-1 reward for our risk objective here. Even knowing that some trades can gap beyond those levels, it's all about kind of just being consistent, following that overall systematic methodology. You can get them as a text alert via WhatsApp as well as the real-time email. So that's something we can help you get set up as well. I do recommend getting both methods of delivery so that you would never miss a trade alert that we would call out when to get in or when to get out. When could you get out with the time stop? It'd be 2 trading days later, that same 3:40 p.m. exit point with still another day to go before the options will expire the following trading day, right? So you're never going to hold them into that expiration day, even though these are 3 DTE, 3 days expiration options when we get them started. Um, so how many trades a month? Up to 8 trades per month. That would average about 2 trades a week. So in the course of a year, that'd be almost 100 trades in a year. In the course of 3 months, that'd be 24, 25 trades in the next 90 days, I think is a reasonable expectation. Will there be day trades? No, there will never be a day trade. We will get in so close to the end of the day that then we're just basically waiting until the next trading day, hopefully the next trading morning, to get our double target. Look at our recommended price of a trade looking back over the past year. In 2024, our recommended entry price was 327, and I believe the beginning of 23 it was $3 even, right? So in that low $3 range, that would get you an average of about 3 contracts on $1,000 invested per trade on average. Some may be more, some may be less. You just adjust accordingly. What are the bonus resources you're going to get today when you get signed up and take advantage of this offer? You're going to get weekly video training from me. And also, when you get the member site access login information in your email with your welcome email that we send you, we will basically remind you that here's how you log in, and you can actually go and watch past week's videos that I've done. So even while you're waiting for the next week's video, which is posted every Monday evening at about 6 o'clock Eastern time onto your member site access, you can also go back and watch past ones, even though you weren't a subscriber then. You can kind of learn from that, see what's worked, see what hasn't, learn for how the winners and losers look over time. You also get the settings and rules sheet for the QQQ options playbook strategy, both specifically what percent of our patterns combined with price action patterns give us a new bull trade or a new bear trade. So you can learn as a home gamer and fellow home trader exactly what we're looking for. So you can ultimately look for this yourself over time too. So a lot of people like to get the validation from us exactly when we're getting in, exactly which option strike price we picked, exactly what our plan is. So you can follow along and kind of piggyback on looking over my shoulder and getting the benefit of what I'm seeing from my 35 years of trading experience. You'll also, of course, our third resource, get our dedicated email address to me and my team of analysts so you can take full advantage of this. And remember what just one trade can do for you, right? I mean, you think about it, right? How fast can you pay back 177 bucks like I said, if you're just investing $1,000 a trade, this one that happened here in late December, you'd have invested two contracts at $391 a piece, and you turn around and flip it and make, as you can see in this example, $782 off of the two trades in, two trades out the next day. So you'd be talking about, like something like 4.5 times your $177 investment back in terms of how quickly you can get it back with just one trade. Obviously, we can't guarantee you the next one's going to be a winner or a loser. It's about following the system consistently. So just determine what your comfort level is to start. Even if you were trading one contract at a time, right? One contract would have made you $391 and more than paid for the $177 access to your next 90 days of subscription. If you came in late, like we said, our QQQ options playbook, a $25,000 portfolio grew to over 134,000 gross before commissions, before subscription investment. That was a 439% gross profit over the last 25 months, right? That assumes you allocated up to and no more than that fixed $5,000 amount per trade through the whole past 2 years and a month look back period. And like we said, you're today getting 90 days, 3 months worth of access, 90 days of access with the settings and rules, with the weekly video training, with the dedicated email to me and my team. If you've got any questions at all, $297 a month times three is an $891 value. Yours today, scratch that almost $900 out. You're getting it for $177. So you're taking something like 80% off of that retail price and saying, hey, for just 177, it's a phenomenal value. One of the things I want to show you before I'm done and hand it back to David in a couple minutes is what the order page looks like. So let me actually pull that up real quick. I need to go over here let me type it in real quick. So it's members. It's not a www link, right? It's members.bigtrends.com/QQQ. So when you pull that link page up here, pulling up right now, you'll see that our pages are again the KISS principle, keeping it simple. I'm not going to load it with a bunch of text, a bunch of hype. It's like, no, look, it's like, okay, you know that one trade can easily pay for this. And the key is that it's about coming in and being consistent, being slow and steady wins the race in your capital allocation. Do not load the boat on any one trade. Just say, look, I'm going to follow this over the next 90 days. That's less than $2 a day with this value. We've already taken all promo code discounts down from 891, taking that extra $700 and change off to take you down. So all you have to do is get your payment info in off of this page, or you can scroll down below in the PayPal link. Once you agree to the terms and conditions, which are hyperlinked there, it shows you in now 25 plus years of serving our Big Trends community, how we serve you, how we do business. If you've ever got a question, if you've ever got an issue, if you've ever got a concern, how you reach us, how you communicate, and we make sure we get you taken care of. And the terms and conditions are spelled out there. And you can click through on the PayPal link and you can pay for it with whatever PayPal source you want to pay. A few clicks later, boom, you're locked in. And now you got the 90 days access with no future auto billing. It's just a one-time investment of the 177. So it's really a great value, great way to try it out for 90 days, give it a fair trial. And you say, well, why don't you give me a free trial? Well, what we found is that free trials, people don't value things that they don't pay for, right? And we feel like, hey, this is a very fair, or better than fair price in my book for the fact that, hey, one trade on $1,000 invested can potentially make you $1,000 on a doubler on the QQQ options playbook strategy, right? Because we're only targeting doubles, we're not targeting less. Sure, if they don't hit their target, you might make less with the time stop when it's executed a couple days later. But you can also see if you forget how to reach us, the top right's got our 800 Big Trends number there. If you forget this number, remember it's 1-800 Big Trends, 1-800-244-8736. You can also email my customer service team directly via clientcare@bigtrends.com. So they'll be there as well to help guide you with any questions you want. But know that this offer is not going to be out there that long. It's way too good of a value, and it's frankly something that I've had subscribers pay a lot more than that effective under $2 a day price point for and still be more than happy with the investment they made, the value they received, and more importantly, the support you're going to receive, right? We're there for you. So again, one last reminder before I hand it to David, back over to David for our next great fellow trader and speaker, is that you go to this link here. It's the link at the very bottom of this page, members.bigtrends.com. Type it in on your chat box, on your search engine page, whatever you use. Members.bigtrends.com/QQQ. It's the beauty of focus here, folks. Focusing on the one vehicle of the queues really laser focuses you in on opportunities and also gives you a great return on your time. You're not worrying about kind of scrambling. You're not so stressed about having to look at hundreds of different symbols and wondering which one do you trade. We only trade one vehicle, the Qs, the QQQ. It's comprising that magnificent seven and more, the top 100 Nasdaq names. You get instant diversification, massive liquidity, and of course the massive flexibility of having daily expiration availability now really allows us to kind of sync up the sweet spot of, a few days out before expiration, picking our expirations one day at a time easily that way, but also knowing we will never hold it into an expiration day. So I'm going to hand it back over to David, see if we had any questions before I wrap it up and he gets ready for our next speaker. Thanks for having me, David. It was a lot of fun.
Yeah, thanks for being here. Great presentation.
I really enjoyed it. Thank you.
Um, yeah, are you able to see the questions?
Yeah, I'm seeing them now. What's the price
Okay.
after 3 months? I mean, it'll revert back up to a more normal price, but we think you'll be more than willing to pay it, Don. So again, if you want to lock in, 2, 3 month trials on this, I'll honor that here. But basically, I can't guarantee that price will stay that low after 3 months. It's just kind of a starter trial point. And had a good question from Sonia saying, "What percent of my account would I suggest risking on each trade? I have a $5,000 account." Well, I was showing you earlier, and I'm glad you mentioned that, Sonia. Is that I was showing you earlier that how you could use, if I go back to where that slide was, we just have the bigger dollar amount there. That's with the $25,000 amount. But basically, we're saying we're using $5,000 a trade on 25 to start, divided by 5 on a $5,000 account. We wouldn't go over $1,000 a trade. I'd say somewhere between 500 and $1,000 a trade on a typical $5,000 starter account is more than reasonable because we're only holding one trade at a time, right? So you're not going to be ever loading all of your portfolio in on any one trade. That'll keep you getting a good bang for your buck, but also helping you to manage the risk accordingly. Let me see if there's any other questions I missed. When will we actually place a trade? After hours? Well, we can get in up to 4:15. That's correct there, B2. Is that basically they get sent about 3:40 when we have a new signal. So like I said, our next one could come here in just under 4 hours. But the idea is that at 3:40, you still have about 35 minutes until the 4:15 close of the QQQ options, right? So don't think they close at 4. The cash market closes at 4, but the QQ options keep trading until 4:15. So that gives you a good half hour. But it's why I recommend not just getting the emails, but also getting the text alerts, which will get you more information about once you get signed up for the email. Jahan asked about a bunch of different stats. You can contact our number, the 800 Big Trends number, or you can also, there's that link you can go to. On that page, it's got our 800 Big Trends number there on that bottom order page there. So go there now before our next speaker gets started. Check it out. Call the 800 Big Trends number, email clientcare@bigtrends.com. We can send you more past performance history on the service. You can study it to your heart's content, but don't let that be a reason to get hung up on any one trade, but rather look at it like, hey, you want to implement a system that has an edge over a long period of time. I got to run, hand it back to David to get ready for our next speaker. Thanks again, David. Great to talk to you and look forward to seeing you again real soon.